a week ago told us exactly what was going to happen. We all went out and bet our money as he advised us, and we made a fortune. But nonetheless, we would if we ever listened to the guy. Omar, good morning. Welcome.
Morning.
Your thoughts this Monday morning as we sit solidly above 70 on Brent and very much close on WTI.
Well, I mean, interestingly enough, early this morning or late last night, depending on where you live, crude actually printed $70 on WTI. Huh? So, and we came off and we're down like 20 something cents right now. But I mean, since that low at 61.56, but there's another one. Anyway, since that recent low, I think basically the market is gonna move higher. The first target is 72 and change, and the second one, if we get above that 72 and change, which I think we will, is about 78, 71. So I'm still bullish on oil. I think we go higher. If you look at equities on the S&P, which is the one I look at, I think that's going to target 4,900. So I think higher. Commodities depends on what you look at, but I think you're going to see them go up again. I don't think lumber has seen its highs. Neither do I think copper has seen its highs. So and I think the dollar index still has a little bit lower to go. It's trading about 90%. I think it gets to 87.59, something like that as a target, then bounces into next year. And then takes a hard hit. But I like the markets, and we're still waiting. Everybody keeps saying shale is coming back. I don't think they will come back for various reasons to do with money, cost of where you can put your money, and the debt that they have, that kind of stuff. And with Iran, I was reading it. Everybody seems to believe that we're coming close to a deal and all the rest of it, which is very possible. I'm not saying no, but I read this very interesting analysis saying that the leader of the supreme leader Khamenei is actually, getting rid of Zarif. So he's on his farewell tour, if you like, and the idea being that they sit and negotiate to show that they're not, that they negotiate, but they will not agree to anything unless it's, complete lifting of sanctions with nothing back for the US. And what they want to do is drag time forwards because they understand that as time ticks by, the US and the Europeans are in a weaker position and the Iranians are in a stronger and stronger position. So that's the kind of counterpoint to somebody who thinks that, a deal's coming and all the rest of it. And it's very interesting that the Western media, the mainstream media keeps saying, deal, here we go, it's all done, it's all this. And still, it stretches out for months. So I think the Iranians are playing for time.
Yeah, they certainly. Well, who doesn't like to spend a few weeks in a five-star hotel in Vienna, as I have had the pleasure to do on many occasions at OPEC meetings? Always get nostalgic when I see the Iranian officials coming out of the Grand Hotel and doing their press conferences. But I diverse. Richard Regolia, Chief Executive Officer, Matrix Global Holdings. Richard, the week that's in it, it's kicking off again a little bit soft, but really somewhat little changed on the close of last week. I'm wondering, did last week solidify above 70 on Brent because of supply or managed supply or, exuberant demand? It seems to me this is still a managed supply market.
Thanks, Sean and Mark and Omar. It is a managed supply market, and we were talking before this. I've kind of been making this point for the past number of months, and some of the things I've been doing is that the most important thing we've experienced, I think, in this last year is the ability to manage supply in real time, which is really a function of this incredible information network that the world has built to understand demand in real time. And when you understand demand in real time, and then you effectively have a Zoom OPEC meeting every month to affect supply in real time, you do two things. You crush forward volatility because now there's really no uncertainty because you know what OPEC is doing. And two, you adjust and cause storage levels to fall relatively precipitously. And it's on a track. So we can talk about Iran, we can talk about what's going to happen with Venezuela and everywhere else. But with the ability of OPEC to adjust supply in real time, I think we've found a market that I have never experienced before in my kind of, I'll not date myself, but a long period
You're
of time.
5 years.
Yeah, excuse me?
I said you're 5 years.
Yeah, I think I've been in this business a little longer than 5 years, but I'll go with that.
Take it. Don't argue
I'll
with
take
it.
5. Make it 6. Make it 6.
Yeah, exactly. Sorry.
And then I think the other thing that happened.
You had a chart, Richard, you were going to share with us?
Yeah, I do. If you could throw that up, I think Irene can throw it up. I think this is, to me, this says it all. We've never seen this before. So demand, as you see, guys, goes up just always. It always goes up. So look at the first time we've really had demand fall for any period of time, and that was the 08-09 recession. It was down for 2 years, peak to peak, so demand getting back to where it was prior, and you saw demand drop around 3.3 million barrels. Look at the chart right next to it. The chart right next to it is the 1 to 12 month crude spread, and I've kind of been a crude spread trader and watched crude spreads most of my life. I think it's very indicative of how markets trade. Notice how long it took for the 1 to 12 month crude spread to get back to where it was in the beginning of 08. It took 5.5 years. Demand fell 3.3 million, but the spread took 5.5 years to get back. Now note what's happened recently. Demand has fallen. We saw the huge drop, obviously, the 15 million barrel drop. And even still, you notice the red line there, demand is still 5 million barrels where it was above the peak at the beginning of, I think, 2020. But note, right now, the peak of the crude spread was only 13 months, and we are already back at the 1 to 12 month crude spread high. That's it, right here. This is telling us how the world has changed.
The world has changed. It certainly has. Let's welcome Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Mark, we have this week yet more stimulus expected out of the US with the infrastructure bill sort of reaching its final sort of pass, if you like, through the Congress. That will, of course, bring forward the great story of inflation again, and yet this sort of upward motion of the markets. Your outlook for that bill and its impact?
I think the bill will probably take a bit longer to get through. There's some optimistic chatter, but this is a hard-won battle, and I think the biggest risk is that people look at the details of the bill and say, well, how much infrastructure spending are we actually going to get, given what the other allocations are made to, particularly other discretionary items, and then because the US is not China. You have to actually think about implementation. How long is it actually going to take to implement? Because that's also equally the same problem with the 750 billion euro recovery package. It's about implementation and how that's done. And I think in all cases, people always need to remember it's all very well throwing big numbers around, but it's actually how the money's spent. And say a country like Germany will waste half of what it's intending to spend. And I'm sure in the United States it's probably no different. It's the same in most developed countries.
As they say, roads to nowhere.
Yes, in a lot of cases. So it is important. It does definitely give a psychological boost. How much of an actual boost to the economy it gives, we'll only get sort of genuine evidence of in about 6 to 12 months' time, is my view.
It certainly over the last year has been massively supportive to markets, whether it be the monetary stimulus or the fiscal. We had some fairly extraordinary comments overnight by Janet Yellen on her return from the G7 meeting, saying that this $4 trillion spend, if it contributes to rising inflation and results in higher interest rates, would actually be good for the US. Your thoughts on those comments and what she's pointing towards?
Well, I think tacitly she's basically saying we would really like to inflate away a lot of the debt that we've got and that we've accumulated, particularly in the last year, and that we're going to accumulate with this infrastructure spending package. It's constructive. It's positive constructivism, I'd call it. It's basically saying if we get better inflation, it means the economy's doing well, demand's strong. what else do we actually want? What are you telling me? Obviously, it doesn't sort of really go to the fine points of, but how is that distributed? But nevertheless, there is some divergence here going on between the Treasury and the Fed, and it's something that the markets will actually grab hold of, particularly if we get to inflation data tomorrow, which comes in again above expectations, and the expectations are already quite lofty. We're talking about US CPI going to 4.7 headline, 3.4. I can see a 3.6, 3.7 number. Those are numbers we haven't seen since the early 90s. And so as much as the labor data was weak, though it's the compilation of US labor data is so poor, it's not true because of the way that they count things. It still wasn't bad, but it will put pressure on the Fed
sort of less
again.
than expected always sort of creates some sort of news angles. But Omar, looking at the digest, our news digest this morning, we have a sort of combination of stories. The point you made earlier, US shale not coming back, and then we have one or two stories of new oil fields into development in Oman and Iraq. The reason their combinations are there is because, in essence, as the sort of IOCs and the big opportunities we've seen in shale and so don't come back due to the lack of capex. The future is really with the NOCs, and then we're starting to see maybe some of the early green shoots of that extra capacity to come from NOCs.
Kind of sure, because I mean, the other way to look at it is nobody's investing, and it's only the NOCs who are in the business. So that's the way I would look at it, more than, the NOCs have an opportunity. Nobody's investing in oil.
Well, the reasons that you've been calling on shale ultimately are growing. I mean, when we, maybe started having that conversation 6-8 months ago, we mightn't have said, well, the majors will be constrained by climate change activism. And now that's an additional reason.
Yeah, but I mean, yes, I agree. But I mean, shale has its own problems. Shale is basically so full of debt that it's absolutely pointless for them to get any kind of capital. It's impossible for them to attract, even if you have inflation, and inflation is running at whatever number you have. What are they going to sell? What bonds? What level are they going to put on interest rates to attract money? 10, 15, 20%? It's just not possible because their debt is so high. They can't attract any capital. So shale is basically, the banks won't call into that because then it makes it as a loss. So they'll keep them kind of, living hand to mouth, so to speak, and that's it. Shale is never coming back. I mean, shale will not grow again. Okay, how it dies is another question. Slowly, probably, but it's not going to grow again. And if you saw, there was a report on Bloomberg today by Vitol saying that now that shale is gone and whatever, and it's what Richard is saying as well. So OPEC plus OPEC, whatever you want to call it, is in control.
Not to want to contribute to the echo chamber, but the Bloomberg story is citing Mike Muller, who was on this webinar yesterday, and now you're quoting the Bloomberg story, quoting Mike Muller. So we're glad to be giving news content to Bloomberg, my old employer. I do owe them a few bucks. Is it something else, or are we seeing the majors now really constrained about sort of deep offshore Mozambique or the Gulf of Mexico?
Well, I think, what we've seen is Exxon build a pipeline, an 850,000 barrel pipeline from Permian to Baytown. So what's happened in the Permian is that all the people who lost money sold it to Chevron and to P66 and to Exxon. It's a cheaper way for them to go. They won't have Omar's right. I think Mark's right. We'll see increases in shale. But the shale is going to will go to 11.3 or 11.5. Is it going to go to 15? No, I think that's probably over with for the time being. But equally as important is what both the IEA, Shell, and Exxon did this last week. They took a gun to their head, they put it to their head, and they said to OPEC, "We're not going to invest in oil anymore. And if you don't listen to us, we're going to shoot." And OPEC said, "Go ahead, pull the trigger." Right? So it's to me, there's nothing like this that's ever happened. To tell Exxon that they can't invest in oil, or they can't invest in Shell, they can't invest in oil, I'm incredulous.
Well, I mean, it's not surprising at this current moment in time. Every dollar they don't spend in the Permian, they're getting back in the oil price. Every dollar they would spend in the Permian, they'd probably lose on the oil price. At this window of time, it's not a moment in which to really make a judgment on shale or others, perhaps, until we get the full 6 million OPEC barrels back.
Yeah, that's probably right. I mean, that chart I showed, I think to me was kind of says it all. This managed supply, I think you've been talking about managed economies for a while in your talks. I think this managed supply is really the outcome of what we've occurred in this last year. I think none of us would have thought we'd be here a year ago, the way this has played out, that they're able to adjust supply. And it really, if you have to go back and look at this is a step function from 2014 when they took the production barrels up to $120. 2008 they took it down from 140 to 27 to 120. In 14 down to 27 again, and then just recently March of last year when they finally said we're not going to do this anymore, and they finally realized we can't keep on going each other, and Russia is part of it now. It doesn't help that Biden calls Putin a murderer. It doesn't help that they're doing all these things. I think we've got one to be careful of. And Mark said it, inflation can get away from you. And when Yellen says inflation is good, it's good for people who have money. If you're struggling and you have to go to two jobs and drive your truck there, and you've got to pay $7 in gasoline, it's not so great. So to me, this is the great disconnect in our political system.
Perhaps it's laying the groundwork for all of us to get used to what will be inevitably, I think, a period of higher interest rates. Mark, your thoughts, just follow up on what Richard said there, but also where do we go from here, do you think, in the demand recovery? I was saying last week was still a managed supply increase with oil above 70. Are we seeing demand now come back and the rubber meet the road, intangible, obviously an amazing Memorial Day weekend in the US, the British bank holiday weekend, and others in Europe starting to look like it's coming back?
We are definitely. I mean, but as everyone always reminds people, petrol consumption isn't the be all and end all of everything, as we know. But here in Poland, I mean, I live in a seaside resort, so the amount of cars which were here at the weekend, and it was a bank holiday weekend, was absolutely preposterous.
More than normal, so to speak.
Oh, even more than normal summer season. It was absolutely crazy. So
I think everywhere is going to get a bionic staycation experience this year.
Yes, absolutely, and that's what we need to keep a close eye on. I'm not sure about air traffic because basically the way the world's going, but I think there's another aspect to it as well, which is there are a lot of people who are actually still quite deeply scarred psychologically. So there are people who are going to go out and spend and have a good time because they've been locked up for so long, but there are also equally a lot of people who are actually quite fearful. And how that actually balances out in the end is really, I don't think anyone knows. To be very
What do you think of the article, speaking of aviation fuel, that we had in the digest today, perhaps in essence talking up his own book, but the fear of missing out will drive return to business travel, says the owner of Business Travel. But nonetheless, this idea that this last piece of the aviation fuel puzzle, this very lucrative piece, could come back over the coming 6 months. Your thoughts?
Well, coming 6 months, I think that's going to be a huge challenge. I think that the thing that people need to remember in terms of business travel is a lot of businesses are basically saying, wow, we can save a lot of money on not having nearly so much. We've achieved a lot over the last year. We've kept our businesses going. Why do we need to go down this particular route? So I think that's someone talking their own book. Personally, I don't think it's going to recover nearly.
Well,
as much as
we've
people
nobody that would ever do that. That's banned here. Let's get the survey question before we get some views on the outlook for the week ahead. Do you expect US-Iran to secure an agreement ahead of the Iranian elections next week? As Omar mentioned in his opening comments, there's been a lot of expectations that this was indeed going to happen. It now feels like it might be draining from the rock. Omar, your thoughts for the week ahead, Monday morning, as we started out saying the market has opened a little bit softly, but ultimately holding on to the gains of last week and looks like sort of consolidating for another move up.
Yeah, I think basically we do move up. I think, broadly, from equities to oil to commodities, things look positive. Things look up. So I don't see the kind of big kind of pitfall or slap in the face that the markets are going to get if they trend higher. At least not yet. So I think the markets are constructive, and I think basically
does inflation offer any threat in as long as the monetary policymakers do not move rates? Inflation will be a good thing for the markets, for the energy and commodity markets.
Well, to be honest,
good as in higher.
I don't think there's a kind of correlation. Okay. Yes and no, but basically, if you think about
as a hedge, ultimately.
Yeah, the world has been trying to inflate since at least 2008, right? The Fed and all central banks have been trying to inflate this market since 2008. Why? Because if they don't, what you get basically is deflation, and in deflation, everything falls. Asset prices fall. Nobody spends anything. And you have, the governments with such massive debts that everybody's literally, dead. So the only way that you save markets or the Western world basically is by having this inflation. Now, they've tried really hard since 2008, got absolutely nowhere. Corona came along and set them back. And now they've gone so far as sending money to people directly into their checking accounts, bank accounts, that they could spend directly. The question is this inflation that we're going to see, is it real? Is it going to last? Is it just a blip? Is it just basically here, spend everything and then, no growth, no nothing? Or is this inflation going to give us basically growth, which basically then, inflates their debt away? So every US dollar becomes worth 10 cents. And therefore your debt you can easily repay. You can do the same with the rest of the Western world, because remember, the West isn't really manufacturing very much. All that's been taken over by China and the Far East, et cetera, et cetera. So the danger is, if interest rates do rise, then how will the government basically pay their debt? So more and more of the money will need to go in financing that.
Well, it becomes a self-fulfilling prophecy in a way, Richard, because ultimately, the more the expectation of inflation, the more people will be willing to pay higher costs on assets in order to protect cash.
And we're seeing it here in spades. Housing prices in California have literally gone up 30%. 30% in 1 year. It's remarkable what we're seing as far as people spending money. And Omar makes a very good point.
And they were already high a year ago.
Higher a year ago, and they just caught fire. The only way out is to inflate away the debt. That is one thing. Just a point on the infrastructure. I know we brought that up a second ago. Yeah. You guys got to keep your eye on Joe Manchin. He's the West Virginian Democrat,
most powerful man in the world at the moment.
He's the one who's kind of keeping his finger in the dike to stop the Democrats from just passing everything with a 51-50 vote. And so I think the market's assuming things will happen. But I also believe that they're looking at, we don't need this much stimulus. We just do not need it. We haven't spent, we used what we've already put a billion, silly me.
The good old days.
In before, I know that was the old days. So but it looks like we're just going to keep on marching up. The money's going to get spent. I don't think we could make a point about what inflation is going to do for another year or so. Is it long lasting or not?
We saw overnight, Richard, the US vaccination numbers crossed the 300 million mark. That's clearly quite bullish for everything.
Yeah, we're opening up. California opens up on June 15th. And magically, everyone gets to take their mask off on June 15th. I kind of walk into stores now without my mask just to say I'm vaccinated. And I give them the V sign, not the V sign. So I try to make them feel like everything's okay. But this, it's very woke here. It's really, it's virtual signaling. If you wear your mask, you're showing your nature for everybody else. But Florida's open, Texas is open, all the big states are open, even New York.
Even New York. Let's get the survey result and give Mark the last word this morning. Do you expect US-Iran deal this week, or essentially ahead of next week's election? The majority is a no. Mark, what do you think is guiding the markets this week?
I think it's still financial repression at the end of the day. As long as both the Fed and the ECB have no intention from stepping back what they're doing, you're looking at you just project forward and say, when am I going to get a decent return on safe assets? And the answer is no time soon. And
we're also starting to see, the other side of where do you pay for this if you don't cap on the inflation, the agreement with the G7 to raise corporate tax across the world, that sort of signals some of the things to come.
It is. It is regulatory intervention, I think, of every type, whether it's Chinese intervention on anything you care to think of at the moment, and they really are intervening every space you can think of, or these sort of attempts at showing global unity. This global corporate tax is about implementation, and we're going to see a lot of flaky implementation on that front, and there will still be a lot of people trying to steal a march on each other to implement tax regimes which aren't necessarily in the spirit of this agreement. But that doesn't really matter. I think in terms of markets, it's still, we've still got this buy the dip mentality baked in the cake for as long as as safe assets basically are not going to offer anything.
Are we overlooking some uncertainties in Asia, and particularly on the commodity side, that are being maybe masked by the weak dollar?
I think the biggest concern I have at the moment is the uptick that we've got and the moves to close down parts of Asia to restrict infection rates. That seems to be the biggest, and it's a good example of how vaccine rollout it is about actually rolling it out equally, because otherwise, if you're great. So the UK has managed this much, the US has managed this much, Europe's catching up, but it's not actually a great rollout in Asia. And with all these restrictions on movements, it's going to be much more stop-start in terms of global economic activity. We'll get there in the end, make no doubt about it, but it's just going to be a lot more stop-start. And so we're going to get these dips, which everyone can buy.
And can we expect the US? We were typically relying last year on China lifting the world out, or at least leading the locomotive in the train. Is that now with the US expected possibly 10% print on GDP in the second quarter?
I think to a large extent it's on the US, but I think what we're also seeing, if we convert survey data into hard data, what people need to understand is we've got a lot of optimism around, but we've also got so many supply chain disruptions in any sphere that you care to think of, whether it's labor supply, raw materials supply, and above all logistics. My biggest concern in terms at the moment is it's quite obvious that logistics in terms of transport and warehousing are not going to step up to the plate of increasing capacity, because they know that, they see it as basically this might last 6, 12 months, 18 months. They bulk up on capacity. And what are they going to do with that capacity afterwards? The shipping industry, above all, has been through this too many times before and saying, it's all fantastic. And then they get left holding the baby.
Well, if you've ever wanted to be a truck driver driving an 18-wheeler down Highway 80 or whatever romantic road you might have, this is your moment. I certainly had a brief period while a student. I thought, geez, I'd really like to do that. as I hitchhiked between Kansas and I don't know where, but that's a whole nother story. Thank you very much, Richard. Really appreciate it.
Thank you.
Mark, thank you for joining us from Poland, and Omar from Dubai, and all the other clocks behind you. Best of luck, everybody. Catch you up with you during the week. Thank you very much. Take care.
You guys.